Good evening. My name is Calvin Lee, and I'm the Vice President of Operation. Our company is G-Light Incorporated, and G-Light Incorporated has an excellent research and development team. The purpose is to develop a high, latest technology flashlight in the industry. The company not just have a research development team, but they also manufacture, production, and distribution of its products throughout America 1, 2, and 3. The plant of production is in Cerritos, and the company's mission statement is to manufacture and distribute high quality and dependable flashlight to consumers in an ethical and responsible manner. Our customers depend on G-Light flashlight to provide light and security in times of darkness and crisis, and for those reasons we are dedicated in providing the best flashlights. And now I'm going to introduce our team, Team 1. Jerry Jimenez, which is the CEO, Melissa Ariano, VP Marketing, Wendy Aldana, VP Production, Jukin Lee, VP Controller, Dong Lee, VP Finance, and myself, VP Operations. And now let me pass it on to Wendy.
Thank you, Calvin. So my name is Wendy Aldana, and I am the VP for Production. And today I'll be presenting the actual results for, versus the performance targets that we configured from the 2-year plan. So the ROA that we were targeting was 17% in year 5, and our actual number was 17.5. For year 6, our target was 21%, and we exceeded by 55%. Our ROE is 12% for year 5, and the actual number was 28%. For year 6, we had forecasted 3%, and we had a high ROE of 113%. The market share was set at 21%, and we obtained a 20.49%. For year 6, our target was 20%, and our actual number was 19.96%. Our stock price was set at $2.33, and our actual number was $1.46. For year 6, we had forecasted $6.93, and our actual number was $7.18. Our unit production cost for year 5 was targeted at $4.25, and the actual number was $5.06. For year 6, our target was $3.99, and our actual number was $2.97. Our total net income forecasted for year 5 was $1,432,000, and our actual number was $2,382,000. For year 6, our target was $2,423,000, and our actual number was $5,567,000. Now I'm going to do the peer comparison for year 5, and our company is number 1, and our ROA was 17.5%, and the industry average was 17.1, so we were above the average. And the leading company was number 4, company 4. The return on equity for our company was at 28%, and the industry average was 29.6. And company 4 had the highest ROE at 60%. The market share industry average was 20%, and we slightly went over it at 20.49%. The highest was company 4 at 26.26%. The stock price industry average was $2.20, and our company was $1.46. And company 4 had the highest stock price at $4.61. Our company had the unit production cost set at $5.06, just above the industry average of $5. And company 5 had the lowest at $3.62. And our total net income was $2,382,000. just slightly below the industry average of 2,539,000. And company 4 had the highest at 4,068,000. Okay, so now for year 6, our ROA was set at 55%, and the industry average was 37%, and company 4 had the highest at 70.9%. The ROE for our company was 113%, and the industry average was 88%, and company 4 had the highest at 225%. The market share industry average was set at 20%, and our company came in at 19.96%. Company 2 had the highest market share at 26.50. The stock price for our company was $7.18. The industry average was $7.59, and company 4 had the highest stock price at $20.82. The unit production cost for our company was $2.97, and the industry average was $3.91, and company 5 had the lowest at $2.10. The total net income for our company was $5,567,000, and the industry average was $4,468,000. And the highest total net income was company 4 at $8,257,000. And now Jerry will be talking to you.
Hello, I am the CEO of G-Light. For our functional strategies concerning our product price, we wanted to increase our price as we introduce new models. For year 5, we planned on having our product price at $12.79. Our actual price was $12.44. For year 6, our planned price was $14.79, and our actual price was $13.87. Our pricing strategy was to price our product similar to those of our competitors. A number of salespeople, we planned on having an average of 61 or 65 employees per area. Our actual was between 58 and 61 employees for year 5. For year 6, our average was from 65 to 68 employees, but we ended up with an average of 61 to 64 employees. Our strategy for salespeople was to have our staff trained and ready for the high seasons of quarter 2 and 4, where we expected higher sales. Our salaries level, our strategy in this area was to increase our salespeople's salary by 5% at the beginning of each year. Those goals were actually met for both years 5 and 6. Our commission rates increased by 2 cents every quarter for years 5 and 6. Our advertising spending, we were planning of spending around $267,000 per area, and we actually spent $278,000 to $287,000 per area in year 5. In year 6, we boosted up our advertising efforts, and we planned of having around $300,000 spent in advertising, but we actually ended up spending $440,000 for year 6 in areas 1, 2, and 3. Our unit sales were actually better than expected. We expected to sell about 430 to 500,000 units in each area, and we actually met those goals for both years. Even though our sales for year 6 were slightly lower than year 5, we were still able to meet most of our planned sales. Our total research and development spending strategy was to heavily increase it in order to have new products available and new models available. Our year 5 planned spending for research and development was $980,000. We actually exceeded those numbers by spending $1.2 million in spending for year 5. In year 6, we only spent $630,000 in research and development. Our product model, we expected to have Model 5 available for year 5 and Model 6 for year 6, and both of those goals were met. Our total training expense rose to $533,000 for year 5 and $785,000 for year 6. Our training expense consisted of us of having our employees ready for those high seasons, and as we introduced new models, we also increased our training expense. Our total beginning inventory was was lower than what we expected. Our inventory strategy was to increase our inventory during the low seasons to have it ready for our high customer demands during quarters 2 and 4 of years 5 and 6. Our production line, since we only had 1 plant, and our max, we ran that production plants to its full capacity of 10 lines at 40 hours. So we had 80 lines per year. Our production output was also higher than expected. For year 5, we expected to have 1,627 units, and we actually produced 2,100 units for year 5. For year 6, our forecast was at 1,620 units, and we actually produced 2,093,000 units. Our total units shipped to sales offices was also higher than expected. Our actual units shipped to sales offices for year 5 was 2,285, and for year 6 it was 2,280. Total units shipped to customers, our plan for year 5 was 1,956. The actual number was 2,057. For year 6, our plan was 1,964, and our actual was 2,166. And now to talk about our SWOT analysis, here is Melissa.
Hi, I'm Melissa Arellano, and I'm the Vice President of Marketing. And our SWOT analysis is one of our biggest strengths was our low unit cost. Since we were producing in Serena, we were able to have a lower unit cost, which allowed us to make more profit. Therefore, offering our customers lower prices. Another strength that we had was high net income, low labor cost, high return on investment, high income to sales, high sales to assets, and we were the only company that sold products in distinctive areas. One of our weaknesses was that we closed America plant. This was a weakness because we closed it a little bit too early. Therefore, we weren't able to produce as much units as were expected. Another weakness was the inability to produce high customer demands, high prices compared to competitors, and we had a lower market share. One of the greatest opportunities our company has is obtaining new models through research and development. Through focusing on research and development, we would be able to have newer models before any other company, therefore allowing us to have a greater market share and making more profit. Another opportunity that we would have would be expanding to other areas, capturing new markets, and increasing our labor force. One of our highest threats was the lower priced product from competitors who had similar products as us, but were selling it at a lower price. Another potential threat would be new models from competitors, currency fluctuation from America, and would be also unit price increasing. I'm going to hand it out now to Duong.
Hi, my name is Duong Lee. I'm Vice President of Finance. The decision-making process, decision consists of unit selling price per area, advertising expense per area, number of sales personnel to maintain per area, the commission rate per area, employee salary per area, whether to obtain or buy back any bank loans, whether to issue or buy back any stocks, whether to issue dividends to our stockholders, whether to purchase any CDs, the amount of money to spend on R&D and training, the quality and features for the new model, production output schedule. At July, we value the opinion of every member on our team every week on Monday morning and Wednesday night. The management team meets up and make decisions for the upcoming quarter. Different aspects of decision would be delegated and as for financial management. All the factors were decided on as a team. Our most important decision was made at the beginning. We developed and committed to a long-term strategy of transition to Sereno to limit costs and high R&D spending to gain technological product edge. Therefore, we did not have many disagreements in overall strategy. Chuku gonna talk about the variance analysis.
Hi, I'm Chukun. I'm the VP controller of G-Line. I'm going to talk about the variance analysis for year 6. First, let's look at the income statement. The gross profit is 30.8%. The biggest factor causing this big difference is believed to be the cost of goods sold. The cost of goods sold is negative 45%. The amount we projected for cost of goods sold was almost twice of the amount of actual cost of goods sold. When we calculate the projected cost of goods sold, we did not expect the currency exchange rate to increase by that much in year 6. The average exchange rate we projected in year 6 was 8.5 and it turned out to be 25 in year 6. We built our plan in Sereno to manufacture our products. With a higher currency exchange rate, the unit production cost would always be low as we converted UPC from pesos to US dollars. The R&D is negative 45.9%. Our strategy for R&D was to increase by 20,000 each quarter in year 6. However, we noticed that it took us at least 2 quarters to get a new model invented. And our latest model was introduced in quarter 2 year 6. It was impossible for us to introduce another new model, so we decided to lower the amount we spend on R&D. Let's look at the balance sheet. The cash balance is negative 62%. We had a negative 62% because we projected positive cash flow all the way throughout year 6, quarter 4. In fact, we had an unexpected negative cash flow in year 5 and year 6. We even took out 2 small amounts of emergency bank loans in year 5. The inventory is negative 100%. It happened because we sold out every single unit of our product in the last quarter of year 6. Accumulated foreign currency adjustment is 64.5%. It was due to the currency exchange rate. As I mentioned earlier, the projected average exchange rate was 8.5 in year 6, but it turned out to be 25. The higher currency exchange rate led to the higher amount of accumulated foreign currency adjustment. Same thing happened to the total equity. The higher exchange rate decreased the owner's equity because the equity was converted from pesos to US dollars. Let's look at the cash flow statement. Production cost is negative 41.8%. The actual production cost was much lower than the projected production cost. Our plan was in Sereno. Every single product was manufactured in there and distributed to sales office in America. So when we calculate the production cost, we needed to convert the production cost from pesos to US dollars. Higher exchange rate always gives us a lower production cost. Okay, the last one, net cash flow is negative 74.9%. The actual net cash flow was much lower than the projected net cash flow. As I mentioned earlier, we never expected to have negative cash flow in our operation when we prepare our pre-year plan. We expected to have positive cash flows all the way throughout the last quarter of year 6. Therefore, we set the net cash flow at a pretty high level, but unfortunately, we had incurred negative cash flow in the last 2 quarters of year 6. With negative net cash flow, our net cash flow was reduced to a very low level. And Kelvin is going to sum up our presentation.
Hi. Lesson learned. There was a few quarters that we were lower inventories, perhaps even out of stock. Therefore, we were unable to maximize our market share and profit. We were unable to produce we're unable to produce due to the limit of the production line. If we were to play the game again, we would invest in R&D more heavily because we can come up with newer models than our competitors. By paying higher salaries to our employees and commission, we can keep the employees and not spend so much on training. Another thing that we can spend on is advertising. This will increase the sales, which will increase a higher net income from the profit. Thank you.